Welcome to Earnings Central. In this video, we'll break down LyondellBasell's second quarter fiscal 2025 earnings. We'll cover key financial performance metrics and dig into insights from the earnings call. All right, let's go. Starting with top-line revenue, the original estimate for Q2 was $7.52 billion. The company actually reported revenue of $7.66 billion, surpassing expectations by 1.9%. However, this quarterly revenue marked a 27.5% decrease compared to the $10.56 billion reported in the same quarter last year. Moving to adjusted earnings per share, the original estimate for Q2 was 80 cents. The company actually reported an EPS of 62 cents, falling short of expectations by 22.5%. This result also reflects a 72.3% decrease compared to the $2.24 per share reported in the same quarter last year. Now let's dive into some additional performance metrics highlighted during the earnings call. The company's EBITDA improved to $715 million in the second quarter, representing a meaningful sequential improvement from the first quarter. This improvement was driven primarily by less downtime following successful turnarounds at their Channelview complex and lower feedstock costs across their operations. Perhaps more importantly, cash flow from operations turned positive in the second quarter at $359 million. This represents a dramatic swing of over $900 million from the negative cash flow experienced in the first quarter. The company attributes this improvement to better working capital management and the resolution of some one-time tax payments related to Hurricane Beryl that impacted the first quarter. The company's $600 million cash improvement plan is not only on track, but actually exceeding expectations. Management now expects to deliver this full amount in 2025, which is above their original target of $500 million. This plan focuses on three key areas: organizational streamlining to reduce fixed costs, working capital optimization through better inventory and payables management, and capital expenditure reductions. Looking ahead to the third quarter, LyondellBasell is guiding for operating rates of 85% across their Olefins and Polyolefins Americas segment. This represents strong utilization levels and should benefit from a completion of their Channelview turnarounds, which had an $85 million negative impact in the second quarter that should reverse in the third quarter. The company maintains a strong liquidity position with over $6 billion available, including $1.7 billion in cash. Management emphasized that while they target a minimum cash balance of $1.4 billion, they have successfully operated at lower levels during previous cycles and remain confident in their financial flexibility. Capital expenditure discipline continues to be a major focus, with the company reducing their 2025 guidance by $200 million to $1.7 billion. This reduction comes primarily from delaying selected growth investments until market conditions improve, while maintaining all necessary sustaining capital to ensure safe and reliable operations. Now, let's shift focus to some of the key insights and takeaways from the earnings call. LyondellBasell is making significant progress on their European asset sale. The company announced the proposed sale of 4 European olefins and polyolefins assets in June, which represents another milestone in their strategy to optimize their global portfolio toward more cost-advantaged regions like North America and the Middle East. One of the most significant decisions announced was the delay of their Flex 2 project until market conditions improve. While management emphasized that the project economics remain highly attractive and the strategic rationale is intact, they've chosen to preserve this growth option rather than commit capital during the current downturn. This decision will reduce 2026 capital expenditures by $300 million. There was encouraging news on the pricing front, particularly for polyethylene. Prices rose in June, marking the first successful price increase in some time. This was supported by strong domestic demand, with second quarter U.S. and Canada polyethylene sales volumes reaching their highest levels since the second quarter of 2022. Export demand has also improved as some trade and tariff uncertainties have been resolved. The company's circular economy initiatives continue to advance, with their MO-Retech 1 chemical recycling plant construction proceeding well in Germany. This 50,000-ton facility uses LyondellBasell's proprietary advanced recycling technology and should begin operations as planned. However, they've delayed the final investment decision on MO-Retech 2, a larger facility planned for Houston, until market conditions improve and firm offtake commitments are secured. Management is closely monitoring rationalization efforts in China, where the NDRC is requesting detailed information on chemical assets. The company expects this could lead to closures of less competitive assets, as the majority of petrochemical facilities in China are currently losing money. LyondellBasell is responding by running their Chinese assets at minimum technical rates. Finally, dividend safety remains a top priority for management. They emphasize their commitment to the current quarterly dividend of $1.37 per share, supported by their strong balance sheet and investment-grade credit rating. The company has suspended share buybacks for 2025 and 2026 to preserve cash, but maintains confidence in their ability to navigate the cycle while protecting shareholder returns. With their disciplined approach to capital allocation and strategic portfolio optimization, LyondellBasell appears well-positioned to emerge stronger when markets eventually recover. That wraps up our recap of LyondellBasell's second quarter fiscal 2025 earnings. If you found this recap helpful and want to stay on top of more earnings reports from other companies, don't forget to subscribe. We've got plenty more quick and easy breakdowns coming your way from Earnings Central.